Joining us here at Post 9 is Goldman Sachs Chief U.S. Strategist David Kostin as an S&P target of 5,600. Welcome back.
Good to have you, Sarah. Good morning.
Nice to see you, too. Now we've seen small caps kind of reassert themselves as an alternative, up a few days in a row at a 52-week high. Is this the unwind of the heavily concentrated AI trade?
Well, I think the way to think about it is the market itself as an index is up 20% year to date. Typical stock in the S&P 500 is up 7%. So that gap has largely been driven by the major 5 companies, which are up dramatically and has helped lift the index. And our forecast is likely that there'll be some broadening of that market over the next 6 months. So the assumptions that we make in our model is that 5,600 will be the level of market at the end of this year. It's our baseline forecast. The economy slows. The Fed cuts interest rates 2 times from now to the end of the year. Earnings rise 8%. And the multiple comes down slightly. That is the baseline forecast. There's obviously some scenarios, Sarah, where you could have a higher level of the market on some different assumptions. But broadly speaking, you get some expectations of broadening of the market.
So what is your confidence level in the broadening of the market, and what has to happen to see that?
Well, I want to think about it in this following way. Since the start of the year, the big 4 hyperscaler stocks have increased their CapEx and R&D spending expectations this year, next year, by $65 billion. Analyst estimates for 2024 and 2025 have increased their CapEx spending by $65 billion. However, your sales forecast for those 4 companies in calendar 25 and 26 have increased by just $35 billion. So that is prima facie evidence right there that the spending is not expected thus far in the analyst community to kind of follow through generating additional sales. Now, that may happen in 2027, 28, 29, sometime further down the line. But from the near-term perspective, that's where portfolio managers are asking the questions. We just had the Goldman Sachs Financial Services M&A conference, which about 250 financial services executives, both private, fintech, public companies, meeting in New York, and asked the question to those in the audience: where are they spending AI? What are the use cases that they're finding? And I was actually surprised how few companies actually are thus far embracing the AI opportunity set. Now, they're beta testing certain things, but I think that's where the questions come. And we're getting more and more questions from portfolio managers, which is kind of where's the beef and where's that going to take place? So I think that's where the debate is in the portfolio manager community right now. The market's been largely led by those companies year to date.
So, David, of the small caps and of the broadening, is there a part that you see as particularly undervalued?
Well, one of the things to think about, Sarah, is the Fed and the expectations the Fed will be cutting interest rates starting in September and probably in December as well. And that historically has been a benefit for smaller cap companies where basically 30% of their borrowings are in the floating rate form, and therefore lower interest rates, lower interest expense, higher earnings estimates would be kind of a consequence of that. So that's one area in particular, if you want to think about from the Russell 2000, or a broadening of the market more generally. Another way to think about it is the premium growth that's expected in some of the largest tech companies is likely to narrow going forward, meaning the expectations of revenue growth, of margins, that's likely to be less dramatically above the forecast for the typical stock. And as that narrows, you'll likely see maybe more of a compression in valuations. Some of these biggest stocks trade high growth rate expectations, 8 times enterprise value to sales, overall market maybe 3 times. So that gap as well, you're paying a big premium, big growth. To the extent that that's delivered upon, that's great. To the extent that it's not, that would obviously be a risk. So broadening of the market would be a general thought process now through the end of the year. Again, the market's already moved 20% this year.